Let's explore some of the strengths and weaknesses of DCF. DCF is an exceptionally versatile valuation method, which is why it is used so frequently in the industry. The greatest advantage of DCF is that it can be applied to value anything that generates cash flow. While we're currently focusing on stocks now, and we've previously looked at some examples involving bonds or real estate, DCF principles can be applied far beyond these. For instance, maybe energy companies can use DCF to decide whether to build a power plant, or maybe pharmaceutical firms can determine whether to proceed with developing a new pipeline drug. So this wide applicability is, I think, most significant. It's a significant strength of DCF valuation. The second advantage of DCF is that it is a valuation method strictly based on intrinsic value. So what is intrinsic value? It means that when valuing a company like, for example, Tesla, the only thing that matters is Tesla itself's performance. So that means that when we used trading comps valuation previously, even if Tesla was a very good company, its valuation couldn't be high if its competitors in the market underperformed. But what about DCF valuation? As long as Tesla performs well, it sells cars effectively, it cuts costs, it generates good cash flow, the valuation results will be high. So this true value of the company is usually called intrinsic value, and DCF has advantages in that it captures the intrinsic value. Number three, it's pretty much very similar to the first one. There are situations where comps valuation is very difficult to use. So for instance, there might be a company operating at a loss, or there might be a company that's in its early stages with almost no financial results. So those kind of situations, as we've discussed in previous sessions. Even in such cases, but DCF valuation, it can be applied. It's very reliable for valuing companies in almost every imaginable scenario. So this ability to handle cases where comps valuation falls short, I think it's another key strength of a DCF. Fourth and last advantage is the ability to explore various scenarios. So since DCF involves working directly with cash flow projections, it allows for in-depth analysis from multiple perspectives. For example, just a couple of years ago, questions like, what will this company's cash flow look like if COVID-19 is resolved within a year, or what happens if not? What happens if it's resolved in 3 years? These kind of scenarios were very frequently modeled, especially for industries like maybe casinos, hotels, travel agencies, airline companies. These kind of companies, intrinsic value highly depended on whether or not COVID-19 resolves quickly or not. And by creating multiple models and comparing the assumption results, we can measure how the resolution of COVID-19 impacts corporate value. While this type of analysis is challenging with other valuation methods like trading comps or transaction comps or any asset-based valuation methodologies, DCF, it really makes it feasible. On the other hand, DCF is not without limitations. It does have its drawbacks. Number one is that a company's intrinsic value is unaffected by market volatility. So as mentioned before, this can also be an advantage, but it also becomes a disadvantage in certain contexts. For example, if the market's frozen and investments are slow and the general sentiment of the market is negative, Yet a company's intrinsic value leads to a high valuation. And could we say that that is truly reflecting the company's accurate value? Well, the answer is yes and no. So while focusing on intrinsic value is a significant strength, the disconnection from the market, I think it can be a very big weakness. Additionally, one of the biggest drawbacks of DCF is the number of assumptions involved. So we've looked at the three-statement model, and even going forward, we have to make assumptions for terminal growth rates and weighted average cost of capital. These can significantly affect the valuation results, even with minor changes like 0.5% or 1% change can have very big differences. So this kind of sensitivity, it often leads to skepticism about DCF valuation's reliability. But that also can be an advantage from a modeling perspective, because sometimes these kind of flexibility can be advantageous. It allows us to adjust for certain desired outcomes. So yeah, from the modeler's perspective, maybe it's a good thing that it's very sensitive. But it does make this valuation methodology unreliable as a whole. Another drawback is the tendency to overestimate the target value. So we tend to make very optimistic projections. It's just simple human psychology. It's not only psychology matters, but there are some practical objectives where usually the purpose of investment is not the purpose of investment, but purpose of doing corporate valuations is usually because you want to invest in something. Usually you thought that in your minds, or in theory you thought that the company is an attractive investment target. That's why you start doing your analysis and doing the financial modeling process. So naturally, the valuation results from DCF could be higher than an outcome of an objective situation. But of course, that disadvantage, it can be applied for just any valuation methodology. But for DCF valuation, because it's very sensitive and highly dependent on its assumptions, it can be more powerful. Next, we do think that DCF is a very complex and time-consuming process. It can be quite tedious. For those of you who already took Financial Modeling 101, I think you've likely spent a significant amount of time and effort. While the method itself was very logical and thorough, it did require a lot of extensive analysis and assumptions. So in terms of efficiency, I think it was quite poor, especially if you compare it to other valuation methodologies. So we've looked over the advantages and disadvantages of DCF valuations. I think that part was specifically more important for those of you preparing for technical interviews. Those kind of questions are going to be especially more difficult if you try to answer on the spot. So it's very hard to come up with advantages and disadvantages instantly. So I think it's a better idea to organize your answers related to the advantages and disadvantages. Next, we are looking at a typical DCF model. So DCF typically follows this structure. So in any company's model, or whoever makes it in any situation, I think it generally looks somewhat like this. Number one, there's always a section for calculating free cash flow. And then there's an area for inputting various assumptions like terminal growth rates and weighted average cost of capital. And above, there's going to be a section on the present value factor We're gonna learn what this is in just a moment. And finally, there's the valuation section where enterprise value and equity value are calculated. So yeah, the models you'll encounter in practice will generally mostly look like this. It won't get any simpler, or well, it can be a little bit more complex than this, but not, you know, significantly different. Lastly, 4 major factors to DCF valuations. So similar to trading comps, DCF also involves 4 key issues that we have to, you know, dive into. Number 1, what is free cash flow, and you know, how should it be estimated? So for those of you who attended one-on-one sessions, I think we briefly discussed this during the working capital section, but let's revisit the concept of free cash flow. The good news is that we've already considered the estimation of free cash flow. So most of the components, the estimation process has been done. So once you understand the concept, the actual calculation and modeling process won't be, you know, too much of additional work in Excel. Number 2, second issue is determining the terminal growth rate. So when valuing a company, you know, we rigorously estimate up to a certain point, and then we make rough projections beyond that. So the rough projection part usually assumes a perpetual growth. It's often referred to as a terminal growth rate. So deciding this percentage, I think it's a very sensitive assumption, and it makes it a very critical factor to consider. Number 3 is setting the time frame for, you know, dividing the 2 parts. You know, some people base their DCF valuation on 5 years. Some people base it on 20 to 30 years. So this choice of this period, it can significantly affect, you know, the company's valuation. So it's a very important consideration, although it is often neglected. The importance of it is often neglected. So we're going to look over this topic as well in just a moment. Lastly, of course, there's a crucial factor, the discount rate or the weighted average cost of capital. Determining this can be highly debated. So it can be significantly influenced by assumptions on capital structures or cost of debt, cost of equity. And I think it is one of the single most sensitive assumption in DCF valuation. So about weighted average cost of capital, we will look over it in Financial Modeling 201 as well, but in Financial Modeling 301, or if you're taking currently the technical interview course, yeah, we're going to be looking at it in more detail. So anyways, these 4 key considerations will be now explored in more detail. The point is that through number 1, free cash flow, to number 3, the forecast year, these assumptions, generally if these increase, it's going to have a positive effect on the results of, you know, enterprise value or equity value. And you can say that for the discount rate, it's the other way around. With this understanding, let's dive deeper into each of these 4 factors.